There's a simple system that can guarantee you never run out of money in retirement, and it only takes 3 buckets to set it up. Now, after working with hundreds of retirees over the last 16 years, I've seen one strategy consistently create peace of mind while turning your nest egg into a reliable paycheck. And the earlier you set it up, the better. So today I'm going to share exactly how to build this system step by step. We'll look at the exact 3 bucket system to transform your investments into a monthly income, and then how much to put into each one of these buckets. That's really specific to your situation. And then 3, the mistake that could actually derail your entire retirement, and then how to avoid it. And then I'll share a story about a client who had enough to retire until the market crashed. But because they had the system in place, they were able to move through it with ease, and they slept soundly during this tumultuous time. This was back in 2020. So let's get into point number 1. Now, what most people get wrong about retirement, they think it's just about having enough money, but really it's about having money, the right money, in the right places. I remember a client called me up there during March of 2020, and they had just retired that year, and now everything just seemed to be going off the rails. And she wondered, should I sell? Should I put more in cash? There's so much going on right now in the world, not just financial, but health related, all these things. What should we do? And she was really worried. So what we did was we reviewed the 3 bucket strategy. We looked at how much she had in bucket number 1, and we saw that we had multiple years worth of withdrawals in that first bucket that were really not down at all. They were actually positive year to date back then. And the relief in her voice was just abundant, and it was immediate. So the action step is calculate your annual spending and then multiply by 1 to 3 years. That's your bucket 1 target. For example, if you spend $50,000 a year annually, this is money that you'll be using from your investments, aim for $50,000 to $150,000 in cash or cash-like investments that aren't going to be impacted if the market drops. Now, what happens if the cash bucket starts to run low, or you start to see it dwindle down as you spend money? Well, this is where bucket 2 comes in, and this could be called the income bucket. This bucket's going to hold 7 to 8 years. It could be anywhere 5 to 8 years of expenses in income producing investments. Now, there is some risk in this bucket. These things will fluctuate a little bit, but they're also producing an income, and they're not going up and down as much as the growth bucket will, or some of those individual stocks or stock funds that you'll have. And some people with this bucket number 2, they've got dividends and interest that's being created in this bucket. They might have that steady stream of dividends and interest be refilling bucket number 1 every year or every so often, sort of like just a steady stream of income. You could either do it manually, or you can have that dividend and interest automatically go into bucket 1 funds. So just to recap, bucket 1 is kind of like a checking account on steroids. That's what you're going to be using for your first expenses. Bucket 2 is the conservative investment portfolio. And then bucket 3, well, that's where things get interesting. Because when you think about it, if you're retiring at 60, it wouldn't be that uncommon to live into your 80s or 90s. So that's 30 years of inflation that's eating away at your purchasing power. We've really been feeling this the last few years, this inflation, just going to the grocery store, right? And seeing how things are getting much more expensive very quickly. Now, even without that last 5-year period that we've had, inflation averages 2 to 3% per year. And over 10 or 20 or 30 years, that really makes a big impact with what actual dollar can buy. So we're going to need some growth assets, some of those stock funds or equity funds or things that will really, they're geared for growth. And these are things that we're not going to need for, hopefully, for 10 years because we've got the first 2 buckets. So it's stocks, it'll go up and down. But remember, we've got many, many years to let it ride before we actually need to tap it. So here's a simple system in action. So let's say that this is how it all works together. You draw from bucket 1 for daily expenses or monthly expenses. And then every quarter, check in on the buckets. If stocks are up, you might want to start to rebalance some from bucket 3 to refill 1 or 2. Or if stocks are down in that bucket 3, then let them recover. You don't have to do anything with that. You could live off your cash cushion for the time being if stocks are down. So that's just a high level, the 3 bucket strategy I wanted to share with you. And remember, retirement isn't just about the numbers, but it's about sleeping soundly, knowing that you've got a system that works in good markets and bad. So the bucket strategy can give you that sort of peace of mind. As always, check with your financial advisor about this. Make sure you do something. This isn't financial advice for you since I don't know your specific situation, but check with the person that knows you best and then see how it could work for you in your retirement.